So let's see, we have Erik Gebhard coming up. Erik, can you hear me?
Yeah, I certainly can.
Where are you broadcasting from today?
Hey, good to hear from you, John. Yeah, I'm in Orange County in my home office here. So just starting off with the summer, all is well.
Good old. You have the World Cup there this week, don't you?
I don't know that. I didn't know that.
I think it's
Uh,
either this week or it's coming up very soon, but I can't imagine what the traffic will be like.
yeah, I try to avoid all of that as much as I possibly can. Absolutely.
Are you
Stay in my
going to
own
any of the
little hamlet.
games?
I am not planning to unless someone calls me and says, "Hey, I got a great idea. Let's go." So,
Yeah, comps you with a free ticket and a helicopter ride there too.
right, right.
All right. Well, go ahead and get your PowerPoint up.
Okay.
Uh, Erik co-founded Altavest. His firm developed the Theta Trader software, which uses a proprietary algorithm to create option spreads and manage risk and reward automatically. Erik, I see automated options trading for the stock market.
Okay.
You have until 5 minutes before the hour. When we
Okay.
hand out our next batch of prizes, I'm going to go ahead and mute myself, and you have the floor.
Great. Thank you. All right, we'll get started. Thanks everyone for joining me. And as you can see on the screen, we're going to look at options trading using automation. We look at strategies for any market condition, even non-directional strategies, and we're going to use automation to help us along the way. So we're not going to be screen watching or anything like that. And we have a unique trade alert functionality as well. And a lot of these strategies that we're going to look at are what you might call professional style of strategies, what the institutions and hedge funds and so forth are often using. And it's not just automation and algos, it's actually real people. So as you can tell, I'm real, at least hopefully you can tell. And that's part of what we do as well. So before we jump in, take a look at that risk disclosure. And if you want to read every word of that, you certainly can take a screenshot of that and save that, but we're not going to read every word together. Keep in mind, past performance is no guarantee of future results. You should always use risk capital when trading. And with that said, we'll jump in here a little bit about AltaVest. We started doing this in 1997 as a brokerage firm. We developed our proprietary options technology along the way after trading millions and millions of contracts. We also trade futures, of course, futures and futures options. We're registered with the CFTC and member of the NFA. We're located in California. And I have my BS in Business Administration from USC, the Trojans, co-founder of AltaVest. I've had several securities licenses over the years with Series 6 and 63, and who cares about the numbers, but mutual funds, annuities, so forth. I have obviously my futures license now, and as well as the investment advisor license. And maybe you've seen us before on some other venues, some of these other places where we've spoken. This was actually a live event in Miami last year. That was actually a lot of fun. That was a big event. There was a lot of big names there too. Congressman and Peter Schiff and so forth spoke. So that was a lot of fun. We had a room of, I think they said about 1,000 people that I had to speak to, and that was actually pretty fun. Although the uh, teleprompter was not working. So anyway, it's a good thing I knew the material well. Let's put it that way. Okay. Sometimes we get quoted in the financial press, and here we are at Market Watch just the other week asking us about energy prices and interest rates and gold prices and whatnot. So maybe you've seen some of our commentary over the years on some of the financial press as well. Okay, so with the introductions out of the way, let's kind of get into the presentation. I think there are really three main things that seem to reoccur in terms of getting in the way of success. How about just information overload? We call it noise, clickbait, you name it. And what about this? This made me laugh. So I think this is more and more accurate and painfully true day by day. You, in the past, used to trade on actually analysis and fundamentals, even technicals. And today it seems just to be money flows and tweets. So different world we're living in. And of course, a lot of that's driven by passive flows and AI and mechanical buying and selling. But that can hinder our decision making with this information overload. You don't know what's important and what isn't, and you sort of end up with this, you know, head in your hand look there. So too much info, not a good thing at times, too much of a good thing. How about the other barrier, which is really time? It's not necessarily a barrier. It's, I guess we all have the same amount of time in a day, but it does take time and discipline to screen watch and, perhaps watch your trades all day if you're day trading. I know some people certainly make it work for them, and I've met them before, but for the vast majority of people, it's just not a realistic type of endeavor. So we're not going to be looking at trades all day, is my point. We have something different, a different approach. And in fact, here's a recent article. They say 5% of day traders make money. So I don't know if that's accurate or not, but maybe so. But I think a lot of that is skewed though too, because there's probably the vast majority of people who say they're going to just try it, on a whim, and then they say they failed. So I'm not sure that really counts. But anyhow, here's the third barrier. Just us being humans. There's a lot of fear and greed involved when we're trading. Anything relating to money ends up susceptible to fear and greed, and we end up on the emotional roller coaster as we're making money and losing money and going up and down our equity curve here. So you obviously like to stay euphoric, but actually that can actually work against you, especially if it happens too early as you start to trade and invest. If you do too well too early, you get overconfident. But anyway, we want to stay off that emotional roller coaster and control our emotions. And we think we can use automated strategies and options to help us defeat those barriers. Absolutely, the answer is yes, we can do that with some technology. And before we jump in, just a brief review of options. Remember, there's always a buyer and there's always a seller. And the buyer pays the premium, whether it's a put or a call, and that person said to be long. They bought the option. Then there is the seller. So for every buyer, there's always a seller, and they collect the premium that the buyer pays. And again, it doesn't matter if it's a put or a call, but that's the dynamic when you're trading options. There's always a buyer and there's always a seller. And of course, there are long option strategies that are really simple, like where you just pay a premium, and it can be an outright bullish position. Here's this green arrow, the market's moving higher. Maybe you buy an out of the money call or even a call spread, and we'll get into that here. Or perhaps you're bearish and you buy some puts down here. Or of course, this is just arbitrary. You could buy closer to the money puts. You just pay more money for them. So those are long option strategies where you actually pay the premium, and those are called debits trades. And then there are short option strategies, and you can also use puts and calls and sell them and collect the premium, whether you're bullish or bearish. If you're bullish here in this green arrow example, you might sell some out of the money puts, hoping the market keeps going higher or stays where it is. Same thing with the bearish market, you sell the calls. And then we're going to look at this too, non-directional strategies. If a market is staying in a range, and maybe you think it's going to be in a range for a while, you can sell some out of the money calls and out of the money puts and collect premium on both sides. Before we jump into the demo, let's learn some Greek. There are two Greek letters we're going to look at. Delta. It's what is it? The option traders look at delta here, and how much does the option value change with the change in the underlying index? So that is the formal definition of delta. But option traders look at it as the approximate probability of an option expiring in the money. And for example, if an option delta is 0.2, that means there's a 20% chance that option expires in the money. But what's the flip side of that? 80% chance that it would expire worthless. So we're going to look at that carefully here in just a second. Remember, the delta is always moving up and down. It's not just a static number, it's dynamic, and you'll never have to calculate it yourself. So don't worry about that. And it is not representing the probability of a winning trade. And theta, sensitivity to time. So you've got time decay. Remember, options have limited life. They always have an expiration date. So at some point, those options are going to expire. So theta is referred to when you're talking about options, or time is referred to as theta. It's a negative number. It equals 1 day of time decay. Here's what it might look like on a graph. And as you approach time zero, the percent of that option value or the premium is just dropping and dropping and dropping in terms of its theta. So in other words, the time is just getting shorter, the clock is ticking, and time is running out on that option. So how can we use delta and theta in our strategies? And here's just a short little graph or chart there of some various strategies. Maybe we can look at professional strategies, the ones that the hedge funds might use and institutions and prop trading funds and so forth. And maybe we'll look at selling options. And here's a little article here, top 10 reasons why selling options is better than buying options. And I think there's a little bit of hyperbole in that sentence, but generally speaking, I'm going to show you why I think that's a true statement. They're talking about professionalism. So you can, when you're selling options, it requires a disciplined approach, understanding mechanics, managing risk like a professional, and it distinguishes option sellers from novice speculators. They talk about long-term growth, often preferred by long-term investors who value consistency over high-risk speculation. So I think there's a lot of truth to that. And I asked AI, speaking of AI, it's everywhere, so why not ask AI its opinion on selling options? So why do professionals do it? Well, they take advantage of that time decay advantage. So we talked about that with theta decay. They talk about the higher probability of profit because the seller receives the premium up front. There's income generation strategies as well. And then you have those market neutral strategies where you sell options, collect the premium, and there's potential even if the market goes sideways. And then you can exploit market inefficiencies. So kind of to summarize, it says selling options is a preferred strategy for many professionals. So hard to argue with that or against that. And Wall Street pros trade option spreads and they collect premium. And we're going to look at some examples here. They're using theta decay to their advantage, collecting premium from the buyer to offset any cost of buying options. So we can do this in combination. Here's an example, typical spread strategy on the S&P 500 mini. So you might sell an out of the money put spread here. That's called a credit spread. And you're looking for the market, in this case, to either go sideways or higher, or even if it dropped slowly over a period of time, that would be fine too. So here's the market, it's trading higher and higher. You sold this out of the money put spread to somebody else, and you collected net premium for doing so. And just so you know, the red line means you sold a put, and the blue line means you bought a further out of the money put as protection or a hedge. You don't want to be naked or uncovered when you're doing this. And you can see here, I'll explain how this works, but you see the blue arrow here pointing to this blue box called the RTI indicator. That's our color-coded automation. So this is where the trigger comes here on this day, right here, and then you close out the position. So that's just an example. Here's a condor trade, non-directional strategy, where you sell an out-of-the-money put, but you simultaneously sell an out-of-the-money call. And you look for the market to stay between those red lines, generally speaking. That's the idea there. And sure enough, so you see here, you place that trade, you collect net premium on the calls and the puts, and the market's just kind of bouncing around, up and down, up and down, up and down. And then eventually here, theta decay works, and you close out that position before expiration. So you sell it, you collect the money, and then you buy it back for a lower price before expiration. And here's another variation on a condor, or a variation. So you can see the structure here with the calls and the puts. You're collecting premium on this strategy. And again, the market's chopping around, and you can see right here, you get your signal here to close out the position and take your profits and move on. And I'll explain this structure a little bit more, but essentially you sell the calls, you buy some a call, and you buy some further out calls, and you do the same thing here with the puts. And the Dragonfly, just so you know, it's non-directional and it's a little more risk averse than a condor, but your potential for profit is also diminished because you spend money to buy this call and you spend money to buy this put. So that's additional insurance, so to speak, or protection against those short puts here and short calls there. So there's other directional spreads that you can do that are bullish and bearish in nature, of course. We just looked at a few non-directionals. Here's something we call a bull hedge. And it's really just a combination spread. We gave it a clever name. And really what you're doing, this is simultaneously, if you're bullish, you sell an out of the money put spread, and with the money you collect, you buy an out of the money call spread. So you can often do this, it says here, for a credit or no money. It doesn't really cost you anything to place the trade. Doesn't mean there's no risk, but in this case, you see, you pay premium up here for this spread you buy, and you collect premium down here for the spread you sell. And if the market moves in your favor, then that would work well. And you see the RTI here. And in fact, this trade really only doesn't work if the market drops suddenly. So it can go up a bit, it can go sideways a bit, you can even drop a little bit as long as it doesn't drop too suddenly. A trade like this won't hurt you. And then there's just the opposite. If you're bearish, you could do something like this as well. And just the opposite or inverse of what we looked at. So you think the market's going to drop, so you buy an out of the money put spread, you pay money for that, but then you sell an out of the money call spread and you take that money and it just finances the purchase of that put spread. And again, these can often be done at a credit if you time things well, or at least even money. And then here's the thing that rookies do, and you want to avoid this. And this is a great little article if you want to look at it, or actually I think it's on YouTube. You can look it up. But she has a lot of makes a lot of good points here, and she's talking to other traders and so forth. But she says, why is this popular trading strategy is so risky? And she's talking about this. Majority of small-time traders are buying the most basic call and put options, and they have a much lower probability of profit versus advanced strategies like option spreads. So that's what she's talking about. You can't just rely on buying a call or buying a put over and over. And it says here, everybody in the business knows that if you're only buying out of the money calls, you're likely going to lose money over time. And that's from John Foley, CEO of Options AI. So I think that's a fair assessment, and we want to avoid that. So we're going to look at spread technology driven by technology, or spread strategies, I should say. And these are option spreads. Our proprietary algorithm creates what we call theta trades every day, and also the trade alert functionality. So all market conditions, and we're going to use automation, color coding. So we're going to jump into our demo right now, if I'm fortunate enough to switch screens here without any hiccups. So give me 1 second. Okay, good. I think we're on track here. So let me do this here, if I can find my mouse. Okay, so let me magnify that a little bit, help you see the screen. I always like to magnify things so I don't have to squint and so forth, and hopefully everyone can see that. Okay, so here's the dashboard for Theta Trader. Your dashboard would look very similar, except a lot of these items up in the menu bar would be a little different. And this is a demo account I use for presentations every week. So you'll notice up here there's trade alerts, and we'll look at that in a second. Then you have your theta trades for today. You'll notice there are bullish strategies that are already pre-built, that they sort of pre-populate, and bearish and neutral or non-directional. And you'll notice 3 markets: the E-mini, S&P 500, NASDAQ 100, and Russell 2000. These are all E-minis. And really the bottom line is that's where so much liquidity and volume is. So that's why it's important to have a liquid market. If you're doing spreads, you want the execution to be as favorable as possible. And we'll explain a little bit more about that. But down here would be your open short positions on your dashboard. So these are any short or premium collection spreads that you've placed, and you can see them all listed here with your days till expiration, and then your color coding and so forth. Any open bot or long positions, and right now there are none. And over here you got price quotes, and then over here you have your account information, and this is all, of course, integrated with your trading account with us. So this is a AltaVest technology that we developed for our clients. So this would be all integrated with your trading account. So why don't we look at a couple of examples here on the neutral trades. So we're going to be looking at collecting premium. Here's an iron condor position here, has 57 days till expiration. Sometimes there could be 3 or 4 different trades, but the algorithm has chosen this. It's already pre-selected the strike price and the expiration date, shows your maximum profit potential at expiration and your targeted annualized return. And those are numbers and metrics, I guess you could say, to compare one trade versus another. And let me go ahead and just show you what it looks like if you drill down and look at the details on this. And then we'll look at a dragonfly next, and then we'll look at maybe a couple bullish and bearish positions. And then also we have up here, we have a trade simulator. I'm going to show you how that works. So here, we're looking at this dragonfly. I'm sorry, condor, and here's what it looks like. The market's trading here, and here's the out-of-the-money call spread you sell and the out-of-the-money put spread that you sell. And you look for the market to kind of stay within that range between those red lines. So that gives you some perspective. And you'll notice all the details here, the days till expiration, the settlement value, the premium, the put risk, call risk, commission, cash required, profit potential, targeted return on cash, targeted annualized return. So you can see here you're selling the 68 put and you're selling the 82 call, but you're also buying a 67.80 put and buying an 82.20 call as protection or to cover these short puts and calls. And here's one thing I want to point out. We talked a little bit about delta. You'll see the put that was chosen by the algo shows a delta of 8.27. So there's over a 91% probability that this put will expire out of the money. So when you sell it, whoever else is buying it, has a 91% probability plus that that option they bought will expire out of the money. And then you look at the call here, the delta is 7.16. So again, almost a 93% probability that this call you're selling to someone else is going to expire out of the money. So you're selling this put and call and you're collecting the premium that somebody else is paying you. And then you use these puts and calls here to buy them and cover some of those puts and calls that you've sold. And the result is you collect a net premium. So the put you buy and the put you sell here, you do so and collect the net premium, and the same with the calls. And you can see the put here, the spread here, the total price of 2.15, and you could do a quantity of any number you wanted. You can see the cash required moves up and down. And sometimes people will comment, and I'll make a point here. This number at the moment, you've got $913.50 of cash required for the trade. So essentially look at that as your margin deposit. That's your maximum risk if everything kind of went the wrong way. But your maximum potential is not even $90. So why would you do that trade? Well, the answer lies in the delta. So again, it's a higher probability outcome. That's why. And we'll go ahead and we'll do, how about 8 of these? We'll place the order. And as a demo account, just assumes your order's filled. And it's just that simple. So that's how that works. And let me show you now a dragonfly. And we'll get back to the trade alert in a second. In fact, what I can do right now is just show you a simulation here. You can go back in time and pick any date in the last, it's over 10 years now of history. I think we have like 12 years. And you can compare any strategy over any period or window of time. And you can kind of run this simulation. You can use these tools down here. So you can go forward in time, backwards in time, go all the way back, all the way forward. And you can see day by day here, you can see the green RTI. That means good, don't do anything. And we'll just keep watching what happens here. So again, this is a condor. So you've got the call spread you sold, the put spread you sold. See the market's chopping around. It's starting to drop, and now you get a yellow RTI, which means elevated risk, but don't do anything. And then is right here, you get the blue signal, and that tells you to close out that position and take your money and move on to another trade before expiration. You always want to close these out before expiration. And we can also automate this so you do not have to screen watch. DataTrader monitors that account for you. So let me go back and let's look at a dragonfly real quick. So here's a dragonfly, and I just will randomly pick this July into month expiration here. It's on the E-mini S&P 500. You can see the profit potential here, $336, targeted annualized return. You can see how you can use these to compare one trade to another. And generally speaking, the trades that have the shorter days till expirations are going to have a higher targeted annualized return. But here's what it looks like. So the quantity is, the breakdown is you sell 4 calls, you buy 3 further out of the money calls, and then 1 closer to the money call. Then the same structure with the puts, you sell 4, you buy 3 further out of the money, and then 1 closer to the money put. So it's a 4 by 1 by 3 on the calls and the puts. And here's the market trading. So you want the market to stay between those red lines. And you buy this put here and you buy this call. So you give up a little bit of premium that you had collected. And that just provides additional insurance and it makes the trade a little more robust versus a condor. But at the same time, it also does give away a little bit of your profit potential. But yeah, the same type of idea here with the chart. You can see the cash required, of course, is higher because you're selling a minimum quantities of 4 calls and 4 puts here. And then your profit potential, targeted return on cash. But again, the puts and the calls that you sell have deltas of 9.5 and 6.2. So, over 90% and 93% probability that the puts and the calls that you're selling to someone else and collecting premium on are going to expire out of the money. And we'll go ahead and why don't we do 4 of these? And we'll go ahead and place that trade. And there it is, just shows up as being filled. Okay, so here is the simulator again. We looked at a condor. In fact, let me squeeze this down a little so you can see more of the screen. So we looked at a condor. Now we're going to look at a dragonfly for that same April week 2 expiration. So just giving you a comparison between the condor and the dragonfly and sort of a sample of how it works. And you can see the yellow RTI, elevated risk, but still do nothing. And then you get a blue profit-taking signal. So you close out the position right there. You take your, take your money and you move on. So let's look at a couple more simulations here. Here's another condor trade. All right, we'll use the play button. So theta decay is starting to work, and then you get a profit-taking signal right here with 9 days till expiration. And now if we want to compare that to a dragonfly, so now you have the market moving, and then the dragonfly gets a profit-taking signal here with 15 days till expiration. So I wanted to point that out. Compared to a condor, there are times when, so you closed out the trade on October 30, but you did instead of a condor, you did a dragonfly, you would close out the trade on October 24, so 6 days earlier. So you're allowed to close out that position earlier and take your profit and move on to something else. So the dragonfly can be more robust at times, more risk averse, and also can allow you to close out the trade a little bit earlier sometimes versus a condor. So that's what I wanted to point out there. Now let's look at another condor and compare to a dragonfly. So you get a red RTI here, and that means too much risk, get out of the trade, take a loss, and move on. So, some of these trades are going to lose money. Obviously, you trade enough and you're going to lose some trades, right? There's no way you can trade. There's no possibility of profit without risk. I think that's kind of what I'm trying to say. So, but let's look at this trade. That's the end of month May condor, and that was a losing trade. But here's the end of month May expiration for the dragonfly. So the same exact day, same expiration, and instead of doing a condor, you did a dragonfly. So again, elevated risk with the yellow and orange, even higher risk. Then it turns green again, and then it turns blue for a profit-taking order. So the dragonfly ended up being a profitable trade versus this condor that ended up being a losing trade. And again, the reason why is you own this call right here. So the delta is higher. And when you own it, it's going to be more sensitive and it's going to gain in value more rapidly than the calls that you have sold. So it can allow you a little more staying power sometimes versus a condor. Now, here's a few examples. Maybe you're bullish. I mean, obviously, if you were bullish in the last couple of months, things would be working out well for you, other than today. But here's an example of a bull hedge. And essentially, what you're doing here is you sell this out of the money put spread, and with that money you've collected, you buy an out of the money call spread. And if the market moves higher, then of course the trade's going to work out well. And just giving you an example of some bullish positions too that are available. And you could also do, let's see here, which trade was this? Oh, I just wanted to point out, I think that even a dragonfly is susceptible to, taking a loss. These are not, I don't want to seem like I'm cherry picking anything. So you can see here, even right here, it turns red and it says, get out, take your loss and move on. But it is more robust than a condor, that's for sure. Now let me point out how you do the actual, let's see, where did we have it here? The actual automation. You go under settings here, under the account settings, and you'll go to, oh, my mouse kind of choked on me there. So you go to your account settings, that's the screen here, and you'll see activate risk manager. You'll click that, and then right now it's on the default red level. You could change it to orange, or you could customize it anywhere from 50 to 30, 25, that's right. But keep in mind, if you lower the risk level to say 25 or 38, then you're going to have more losing trades, but the amount or the magnitude of those trades will be smaller versus the default level. So it's up to you what you're comfortable with. I use just 50 here for the presentations, and then you'll just save those settings. And if you want to save your profit directive, that means close out the trade when it hits a red or a blue, whichever comes first, you save your settings. So that's how simple it is to automate the tracking. There's also a great help file if you want a little deeper dive into all of the strategies, the definitions. Here's all definitions for the strategies, the symbols, and as well, the color coding for the RTI. So that's all part of this here. And I also want to point out we do have a TradeScope newsletter we do every day. That's our proprietary research we do in-house and gives a brief overview. We usually look at the S&P, NASDAQ, and or the Russell, give you an idea of what we're looking at. We review some of the options flows. We look at what's going on with the global macro landscape. And it's really just 1 or 2 pages. So it's something you can look at in just a few minutes. And really people like to look at that and get what they need to know. So now going back to the home page here, you can see you have this trade alert and it says view the trade alert. So that means a trade alert was sent to you and your account. So I can look at it here. I've already pulled it up. So this is what it would look like. And here's one for today. It's a dragonfly spread. And here's the position for the dragonfly. You can see the graph there explaining everything. So you're selling these 4 calls. You're buying 3 further out of the money calls as protection and an additional 1 call closer to the money. And the same with the puts. So you'll notice the quantity is pre-selected for you. It shows up as 8, and that's customized for this particular account. In other words, the account balance you have, the available cash you have, and any other open positions you have, you will only receive trade alerts that are appropriate for you and your account size, also based on what other positions you have. And the quantity is pre-selected for you, but you can change it by lowering it. You cannot increase your risk though. So that's important. Sometimes people think, okay, that's great. I see 8 of them coming in as a trade alert. I'll go ahead and do 6 of them for some whatever reason. But you can see here, everything is selected for you. Here's the trade itself. The entry price, you're trying to collect over 9 points for that and collect this amount of premium, cash required, and it has 57 days till expiration. And remember, this is the expiration date here, and you're not planning to hold this for 57 days. So usually a typical, dragonfly, you can close that out in half of that time and hopefully for a profit. But that's kind of what it looks like when you receive a trade alert. It's customized to you and your account. If you want to accept it, you just click that button and you accept that alert, and it shows up right there, of course, in this demo account as being filled. So hopefully that makes a lot of sense. And then I want to point out that you're not going to just want to do neutral strategies all the time, I assume. But if you're bearish on any of the markets or bullish on any of the markets, you can see any of these strategies here that are pre-populated, and you can simply buy a put or call, put spreads. You can do butterflies positions. You can actually buy condors, so on and so forth. So these are all available and they're pre-populated. You can see all the choices here today on bull hedges. So depending on if you're bullish or bearish or neutral, it's all right here and everything is pre-built. Plus you get all of the trade alerts coming to you as well. All right. Also wanted to make one other observation here, and let's see, where was that? Guess we can do it right here. We have a video tutorial here on navigating through Theta Trader, and these are just 1 or 2 minute videos, really short and sweet, and how to place trades and so forth. But we also have an education section on options trading and specifically spreads and index options. So that's very helpful as well. We call it sort of our master class in education. These are not hours and hours. These are usually about 10 minutes per chapter. So we just tell you what we think is important and what you need to know. We're not going to get too heavy and too deep into the weeds. Sort of defeats the purpose. We built Theta Trader to make it user friendly. And then there is this help file as well that we were on. And you can see there's just all of the details here in the help file. But so much of it is, I guess you could say, self-explanatory or self-evident. You probably don't really need any additional help once you just spend a few minutes with it. But anyway, so there is the Theta Trader dashboard. Now let me switch gears and show you the best feature of all. If you have any comments or questions, certainly send those in, and we'll get to those in just a bit. And also, everything in Theta Trader is net of cost. So all the dollar figures and percentages are net of all your trading cost as well. So just want to make that clear. So here is, I think, probably the best feature of all. It's the trade alerts, but they come to you via your phone. So all you do is touch accept, and that's how you place your order. So that's it. That's all you have to do. And here's an example. If I can get this going here, you'll get a text message. You'll touch that message. It'll link you right to the alert that's custom for you. So here's another Dragonfly alert. Obviously, those are the calls and those are the puts on the position. And here's the current market trading here. And it has a quantity of 5 customized for you, but of course you can adjust that lower if you would like. You can't go higher, but you can go lower. It gives you all the details on the trade, the entry price, how much you're collecting, your cash required. So if you like it, you accept it, or you just reject it if you don't want it. And that's all you do. So it's very user-friendly and intuitive. And then once you accept an alert and it's filled, assuming the trade is filled, then Theta Trader will automatically track it for you day by day. You just saw that in the dashboard and on the settings there, how you can automate the risk and the reward. So here's how to get started with Theta Trader. So everything you saw which is really all of the Theta Trader software, including the Theta Trades, the RTI, which is the risk thermal indicator, that's the color coding automation for risk and profit, and then the trade simulation you saw going there backwards in time. And that's a really great tool to use. It's actually, I guess you could say, what do they call? I'm not thinking of, not an infomercial. It's entertaining and productive. Let's put it that way. So your value there is over $3,500 using just the Theta Trader software, but it also includes the trade alert technology that we saw. So those trade alerts come directly to you in your phone, also via email and on the dashboard, and they're integrated with your trading account. You just touch accept or reject. And the value there of over $4,400 for that trade alert service. So you have the Theta Trader and the alerts valued at over $8,000, but it's not just technology. We're real people. And part of what we do is service people on the phone and also with screen sharing sessions. We're all registered and licensed and experienced to be able to do, of course, what we do. And how much does a service cost for retail? I'm not sure how that got yellowed out. I guess that was my fault. But it's $5,000 to $15,000 according to AI for coaching, for trading coaching. What we're saying is we provide that with Theta Trader. That's just part of what we offer in our service here. So we think that's a value of at least $10,000 to have that personal coaching available to you. So you have all the technology, including the alerts with the private coaching. I mean, if you think about it, where can you get private coaching for anything unless you're going to spend quite a bit of money? And that's really what we include as part of the package as a Theta Trader member. So that value of over $18,000. And let's not forget the proprietary research. I showed you the trade scope. That's just that 1 or 2 page document we produce every day. And then we have our futures and options masterclass education that's available within Theta Trader as well. You can see all the various chapters there. Those are short tutorials and videos. It's not going to overwhelm you, and you're going to learn a lot, I promise you. And that value almost $2,000 on that education package. So combined with our research, the yearly value, $2,952. And then we have some of those tutorials that are all just part of the Theta Trader package as well. So just to summarize everything, you have Theta Trader, you have the alerts, you have the private coaching, you have all the education available to you, valued at over $21,000. And we call that our Theta Trader professional options package. But of course, that's not the price we're making that available for. This is what we used to sell Theta Trader packages for when we do in-person live events and seminars. We'd have the forms at the back of the room, have a table set up, and after the presentation, people come back and chat with us, and then they would sign up right there. And so in-person live events, that's the rate that people were paying, but we're going to do much better than that. In fact, we're going to do better than our retail price on our website. If you just show up at our website, $997. So we're going to do much better than that for you. This is our lifetime membership, and it's just a one-time payment. So I want to make that true, make that clear. And this is for the Mad Hedge Summit. We'll do this for today, $797. So cf.altivest.com/mad. That's the link to use. And that's my phone number, and that's my email as well. And use the QR code. In fact, take a picture of the screen and save that so you have that with you. But that does time out later this evening. Now here's the thing too. How about a free membership? If you have $100,000 or more in your account, we rebate that membership fee to you. And if you have 25,000 and above, we rebate 50% of that rebate to you. So people take advantage of that all the time. That's a nice thing to do. If you know you're going to be trading with us, why not get that rebate? And really, you have no risk on that membership fee anyway. You sign up and something happens and you decide it's not for you in the next month, just let us know. We just refund that membership, and that's fine. In fact, in the meantime, you can be using Theta Trader in demo mode and getting comfortable and familiar with it and learning a lot. So really, you don't have any risk on that membership fee. You can only learn and improve and kind of gain some different insight along the way. So few FAQs. Why E-minis? Well, here's a few advantages. Again, using AI, lower cost, capital efficiency, defined risk, reduced volatility exposure, improved probability of profit with spread structures, kind of what we talked about. Look at their iron condors. Cost-effective directional and range strategies. So again, We looked at those bullish and bearish strategies as well. And it talks about time decay management, capturing theta. We talked about theta decay. How about flexibility? Again, so all these strategies can be customized and tailored to any particular situation and your risk tolerance. And here's a big one, execution and liquidity on the E-minis. And then it says here, multi-leg combos use exchange multi-leg execution. So what they're talking about there is, I'll show you, if you're going to do a dragonfly trade on an individual stock, you're going to have to break it up into two separate orders. But when you're trading with us and using Theta Trader, you can do everything at just one price and one order. You don't have to leg in and leg out. So that's a big difference there, folks. When you're looking at execution and making your life easier, you can do that with Theta Trader and trading these E-minis. How about another advantage, which seems kind of obvious? You don't have to look at 6,000 different securities. We're looking at the indexes, and that's where all the volume and activity is. So again, you got the premium collection spreads here. You have limited risk professional strategies, customizable, higher probability outcomes when you're selling options, looking at the deltas. There's a lot of flexibility for up, down, or sideways conditions. You have a wide margin of error. You don't always need to accurately pick a direction when you have non-directional strategies. In fact, here's an example of a trade just the other day where you're selling the 8150 calls and the 6475 puts. So you've got 1,675 points on the S&P between the calls and the puts that you've sold. So if the market's just chopping around in that wide range in the next few weeks, then that trade should do very well. And just to kind of put a finer point on things, the short option strategies, again, you're collecting premium. You've got non-directional strategies where you sell a call and you sell a put, and maybe bull market strategies here. The market's moving higher and maybe you sell an out of the money put spread. So the green line is the put you sell, and the blue, green, I'm going colorblind here, and the red line is the put you buy. And same thing on the opposite side here. If you're bearish, maybe you sell an out of the money call spread and collect premium that way. And then you have the long option strategies or the debit spreads, and they can be useful at times, and they are limited risk, and you have that asymmetrical return. So you can get big payoffs, but they just don't happen that often because they have that lower probability outcome as per the delta. So this is what that might look like here with the long option strategies. If you think the market's in a range and it's going to break out one way or another, you could simply buy calls and puts like a straddle or a strangle. That would be, I think, the same strike price. And then maybe you just buy an out of the money call spread if you're bullish. You pay money for the call here and you sell one higher to pay for some of the one that you bought, and vice versa with the put. So lots of different possibilities. In fact, the possibilities are really endless. But remember too, there's no margin calls when trading spreads with AltaVest because we're always doing covered strategies. So the Dragonfly, for example, our proprietary approach, for every option you sell, you have a bot option. So these are coverage strategies, no unlimited risk, and that means there's no margin calls. You're not going to be forced out of the position. So no margin calls. And there's also tax efficiency, some other big advantages there. All E-mini options and all futures and options have tax efficiency. So that means essentially you can lower your tax rate by about 10% with futures and options. The IRS treats these as 1256 contracts. That's how they identify them. And what that means is 60% of the gains are taxed at the capital gains rate versus 40% at your personal income tax rate. So you do get that favorable treatment. And then there's no more itemizing. You have your profit for the end of the year on your 1099, and that's all you need to prepare your taxes. So always consult your attorney or advisor though, because we're not experts in that regard. People ask about IRAs. Absolutely. You can do a self-directed IRA with us. We work with Equity Trust, and they'll waive that setup fee for you if you're with AltaVest. So talk to us about that if you want to work with us on using a self-directed IRA. So remember too, we're full service. We can trade any commodity futures and options market more than just what I just showed you. So I just want to spend a minute here looking at this. What's the best performing asset in the last 20 years? Anyone know? Do we have any guesses? I'm not even sure how I'd see. Would that show up in the chat? Um, let's see here. Oh, yeah, I did pull up the chat and I see an answer. Yeah, that's right. What's the best performing asset in the last 20 years? It's gold. So interesting enough, gold obviously is getting beat up with everything else, I think, today. Anything, well, I guess anything other than what was it? I think healthcare might be higher today. I don't know. Anyway, someone will tell me. Maybe John will chime in later and tell me. But we still have our eye on gold, and it's now replaced U.S. Treasuries as the world's top reserve asset, central bank reserves. You can see the white line represents gold overtaking Treasury holdings. Very interesting there. It's the largest asset in the world by far, 31.3 trillion in size versus Nvidia about 5.3 trillion in size. And then energy prices, they've been, I think they've been suppressed by largely from all of the reserves that the US and the rest of the world is tapping into. So here's some other energy experts. This guy here is saying to stay long oil, demand's above supply. We're drawing inventories, borrowing oil from the future until we hit the tank bottom. We're going to be out of oil into summer. So I don't know the exact timeline, but here he is again. You've got your demand here, your supply here, and when inventory runs out, demand has to come down to supply. So, we're looking at oil as an opportunity as well. Look at the SPR, Strategic Petroleum Reserves, getting drawn down. Here's another graph of it here. Look at that weekly change, just plummeting. It's a big drain on the SPR, 8 million barrels just in a week. So the refineries are also running near max capacity at 94%. And they're talking about California is going to run out of jet and diesel by July. So we shall see. And then this guy here is talking about once U.S. crude inventories are depleted, which could be as soon as mid-July. So it's more than one person saying this, and experts aren't always right. But markets sometimes find a way around these things. But I think the bottom line is here, all of our buffer, whether it's here in the U.S. or elsewhere, is really being run through very, very quickly. And oil prices look to end at the highest levels in over a week, but that was, of course, not considering today. Oil tanks are getting emptier each week. The Hormuz Strait is closed. Talking about commodity super cycle underway, staying long commodities. I think that makes some sense. And this is interesting too. Commodity markets living on borrowed time, continued inventory drawdowns pushing oil. Higher prices may become the primary mechanism for balancing supply and demand. So they're just talking about demand destruction. Oil is going to have to move quite a bit higher before the actual demand for it is reduced. At the moment, it doesn't seem like people are changing their approach to living, at least in the US. I know that, obviously other places, bigger countries, India and so forth, they have their own issues too, and Europe and England and so forth. But it says here, producers and consumers are drawing down the buffers that normally protect the global economy from disruption, and those buffers are now approaching dangerous limits. So here's one thing we like too, the Bloomberg Commodity Index. So here's what it looks like on a graph. So you've got 24 markets in this one index, and here's what it looks like here. The components, energy, grains, metals, precious metals, softs, and livestock. So all the different percentages across those markets. So if you want broad-based exposure to commodities, we think that could make a lot of sense. And here's kind of how it works. The margin is only $800 per contract. Every point represents $100. Contract price was around 138, 139 just the other day. And then, so basically, you've got a March, a June, September, December contract. And here's some other contracts for you to consider. So micro crude oil, that's 100 barrels. The margin's about $1,200 last I looked. So $9,600 worth of crude oil per contract. Here's that Bloomberg Commodity Index. We just looked at that $800 margin deposit controlling about $14,000 of value. And you have a 100-ounce silver contract, and you have the micro gold at 10 ounces. There's also a 1-ounce gold. And then, of course, you've got bigger contracts too. But the point is, there's a lot of flexibility with futures in these commodity markets. And then we can also trade the options on them too. So let's see here, what was I going to say? Oh yeah, Wiz, just before me, I heard him, I caught just a bit of the end of his, but he talked about options as well. And, the leverage in options, as you know, is tremendous. So you can do a lot of wonderful things with these options markets and futures markets, and we can work with you and put a plan together for you as well as having the Theta Trader account as well. So just wanted to point that out. So why alternatives? Well, they may improve portfolio risk and diversification. Bank of America saying commodities could dominate, moving away from the 60-40 portfolio, and they're moving some into gold and energy. So they're talking again, the paradigm shift in the portfolio construction away from that 60-40 bond portfolio, which, that was just an arbitrary thing anyway, if you ask me. Probably should have never been in place for all those years. And they're looking to move some of that into gold. And, part of the reason why is you have that 60-40 portfolio. You see these red shaded areas here in the recent past, and that 60-40 portfolio didn't provide any protection, no edge. So we like diversifying with options and Theta Trader and even some of these other commodity markets, and we can put together strategies for you using futures and options contracts, whether it's to speculate or hedge your portfolio. It doesn't really matter. We can, again, tailor something for you and your particular case. So a lot of questions, I'm sure, a lot of information, and let's go here. BCOM is the ticker for the Bloomberg. That's a good question. And what other questions are there? Commission costs. Yeah, the commissions are all part of Theta Trader, 5.25 round trip on your options. Good question. And let's see here. John says oil are hitting 200 at some point. Yeah, well, maybe, I don't know, John has a few extra thoughts on that, but I think being long the crude complex makes a lot of sense right now, especially with options. We can do vertical bull spreads on options. They don't cost a whole lot of money right now, quite frankly. Uh, get something for December, for example, or even shorter dated. But it's one of those things where the answer almost seems too obvious that it makes me hesitant. But it almost reminds me of the COVID lockdown. I can remember reading in December of 2019 about the virus in China and how China was shutting down, and then January, and I thought, why isn't the market moving on this? This is a huge deal. And the market didn't seem to care at all, at least here in the US, for at least 2 or 3 months. So I guess market doesn't react until it does, But all right, let's see if there's any other questions. Sometimes people, let's see here. Someone's asking about software trading and automating the trade. What's the biggest concern someone might have using Theta Trader? Um, if someone's never traded options, I think the best thing to do is just simply log in and look at the options tutorials and just get familiar with the terminology, the different lexicon, so to speak. But once you get the terminology, there's really nothing that intimidating about it at all. And let's see here. Some people ask, and I don't see it yet, but some people ask about Canada. Let us know where you are. And depending where you are, we can work with Canadians and other parts of the world as well. So, but I think I'm right out of time. And thanks everyone for having me. Thank you again, John. And I don't have anything as sexy as the topic from the prior speaker, but maybe next time I'll come up with something as well. But yeah, give me a call, reach out, go to our site, sign up. There's a guarantee. We'd love to have you on board. We can do some unique options trading and then get you positioned in commodities as well.
All right, Erik, thanks a lot. To take advantage of Erik's offer, here's the link at the bottom of the chat box, cfaltavest.com. That'll take you to the dedicated sales page, only available today.